The new weekly outlook for this upcoming week. This week is going to be one of the most important trading weeks once again. We have the June inflation report dropping on Tuesday in the morning, the biggest bank earnings of quarter two kicking off on the same day, Federal Reserve Chair Kevin Warsh delivering his first congressional testimony, Taiwan Semiconductor reporting Thursday with the most important AI demand signal since Micron's blowout quarter, and an active US-Iran military conflict that has now completely reshuffled the oil, gold, dollar, and the rate markets. So if you trade Forex, commodities, stocks, futures, or funded accounts, everything we cover is going to move this week. And I want to make sure that you guys are fully prepared and understand the full picture before the market opens up on Monday. So let's get right into it. Starting off with the Iran conflict, what actually happened and what it means for your guys' trades. The US and Iran have now exchanged 4 rounds of military strikes in a single week. So I want to walk you through the actual sequence because the specifics will be very important for how you position. So on Tuesday, the 3 commercial vessels were attacked near the Strait of Hormuz. The US coalition raised the threat to severe, which is the highest designation. Overnight into Wednesday, the US Central Command struck more than 80 Iranian targets. I'm talking about air defense systems, command and control networks, anti-ship missile systems, and over 60 Revolutionary Guard small boats that were designed specifically to attack commercial shipping. Trump declared the ceasefire over at the NATO summit in Turkey, saying directly, that is, in his own words, quote unquote, just a waste of time dealing with him. The US Treasury simultaneously revoked the license permitting Iranian oil to be sold in global markets. Then Iran responded by striking 5 U.S. allied nations, Kuwait, Bahrain, Jordan, Qatar, and Oman, with missiles and drones in a single day. Then we had a civilian container ship, which was the Cyprus-flagged Galaxy, and that was hit directly. It suffered significant damage. It could not continue its voyage and has a crew member that's currently missing. Iran's Revolutionary Guard halted 2 additional cargo ships after firing warning shots at vessels attempting to transit the strait. On Saturday, U.S. Central Command struck approximately 140 more targets, which was one of the heaviest actually, bombardments since the original conflict began. Sunday brought a 4th round of U.S. strikes beginning at 5 p.m. New York time. So here's a number that tells you the real story, separate from what the both sides are going to tell you, the diplomatic claims that are going to be made from both sides. That as of Sunday, there were almost no visible ships in the Strait of Hormuz. Only 2 oil products, tankers that were observed approaching the waterway all day. Just 2. That is a physical reality of the world's most important oil shipping lane at the moment. So for people who are trading commodities at the moment, very specifically oil, we're going to see that oil, when the market opened up, was already up 7% on the week, with Brent sitting near $79 a barrel and WTI sitting near $74 to $75 at the moment that you can see. The specific level that changes everything is going to be the $80 here on WTI and even Brent as price continues to push back up. The reason why is just on the weekly time frame. As you continue to zoom out, you see how strong of a level this is. So at $80, markets begin pricing in the probability of a full U.S. naval blockade at the Strait of Hormuz. Trump has threatened to reimpose that blockade, but has not confirmed operational enforcement. So that gap between the threat and the execution is the reason why oil is up 7% and not 20% at the moment. If we get a confirmation of an active physical blockade, then oil will break above $80 and it is going to move to about $85 to $90. So we're going to watch that specific confirmation, not just a general news flow, as the binary trigger for crude this week. Then we also have gold that, of course, was affected by all of this. And we see that gold is sitting at approximately, 4,060 to almost 50 area. And it continues to fall. As you can see, the weekly time frame is continuing to push back down. Even the daily time frame gap down, starting to push back down. Right? And it's falling despite a genuine military escalation in the Middle East. So this is the kind of price action that generally tends to confuse a lot of traders, especially those who are newer to the markets. When you see a conflict escalating and gold falling at the same time, the first instinct is just to think that something is wrong with the data or that the market is making a mistake, but it isn't, right? What's happening is more important to understand than the price level itself. The market is reading this conflict as more like an inflation shock first and a safety event second. Rising oil means rising energy cost. Rising energy cost means that the Fed has to keep interest rates elevated for even longer. And higher interest rates will make gold, which pays no interest, less attractive relative to the bonds that will, right? So gold falls not because the world is getting safer or any other fundamentals, but because the market believes that this energy shock will force the Fed to stay hawkish, which raises real yields, which pressurizes non-yielding assets. So that is the same pattern that we have seen consistently since the Fed's hawkish pivot in June. When geopolitical stress drives energy prices, gold does get caught between a safe haven bid and a rate hike headwind. And right now, the rate hike headwind is winning, right? That $4,000 level, very specifically when you see it on the daily time frame, that is the market holding this level as the structural floor, right? And the market has been defending this area repeatedly. Tuesday's CPI print is going to be the next key catalyst. If inflation data softens, then we will see that gold will get a relief rally. It has to soften meaningfully, though. I'm not talking about just by a small margin. If inflation stays sticky, the pressure continues into the week. Now, here's the macro story that genuinely gets complex, and getting this right is going to determine how you approach your currency trading all week. Matter of fact, your stock trading, your currency trading, your commodity trading, all of that all week. Coming into last week, the market has shifted toward a more patient Fed after the June's job reports that came in at only 57,000, which is well below expectations. Rate hike bets had been pushed back towards only 2 rate hikes potentially for this year, but mainly the focus was on December. But the conflict's re-escalation has pulled those bets back forward, and now the swap markets are pricing in approximately 40 basis points of Federal Reserve rate hikes by December, and potentially 3 total rate hikes by December, which is up from just 15 basis points in early June. September rate hikes are also back on the table. And the dollar is reflecting this in real time. So for that, you come back up to DXY and you see how the dollar has reclaimed above that 101 level. And it's strengthening against every major G10 currency as well. Very specifically, if you come over to Euro USD, you can see how important or how strong this 114 level was, right? Even on the daily time frame or the weekly time frame, it has been a very strong support level. But now, Euro USD has fallen back towards that 114 and just below it. The yen also is remaining near a 40-year low, coming right back down here, and very specifically against USD JPY, it's right now pushing back up closer to that 162 area. So for anyone trading Forex this week or currencies this week, the dollar's fundamental driver has reasserted itself. Oil going up means that U.S. inflation is also expected to go up. That's how the market is seeing this. And if U.S. inflation is expected to go up, then we're expecting higher rates for longer term, which means that we're also expecting a stronger dollar. So that is a transmission chain. It's running very cleanly at the moment. The Fed's own monetary policy report that was released on Friday, so let's come up here and let's go back to last week, that came out on Friday at 11 a.m. Eastern Time or 8 a.m. PST here, reflected the same exact thing. It repeated the same language from its June statement directly, saying that the committee will deliver price stability. Kevin Warsh has also pledged less communication than anyone who came before him, which means that every public appearance will carry a lot more weight for any FOMC member or even Kevin Warsh himself, and it's going to carry a lot more uncertainty than the markets are really used to under any of the previous regimes. So that brings us to Tuesday, right, which is going to be the single most important trading day of this week by a massive margin. Because on Tuesday at 5:30 a.m. PST or 8:30 a.m. Eastern Time, you will get three things that are going to arrive simultaneously. You're going to get the June CPI inflation data from the BLS. You're going to get pre-market earnings from JPMorgan Chase, Goldman Sachs, Citigroup, Wells Fargo, and Bank of America. And then at 10 a.m. Eastern Time or 7 a.m. PST, we're going to have the Federal Reserve Chair, Kevin Warsh, beginning his first ever congressional testimony. So let's go through each one very precisely because the order of importance is probably not going to be what you might assume. On the CPI print, this is going to be the one that requires the most careful reading. We're going to look at, first of all, let's pull up core CPI month over month. The June data may actually show the headline number going negative on a monthly basis. The first negative monthly inflation print since actually the start of the pandemic, but that headline is going to travel. It's going to show up on every news outlet that we're going to look at. But what you actually need to pay attention to is the June data that captures prices from the month of June when the ceasefire was in place and gasoline prices that had fallen sharply. Oil was sitting near $68 to $72 through most of June. And as of right now, we saw that oil had jumped up to around $74 to $79, and it's continuing to rise, right? The energy deflation that's going to show up in Tuesday's headline number is already being reversed in real time by the conflict that resumed this week. So when we open up Forex Factory Tuesday morning and that number drops, we're going to go straight to the core. And then we're going to look at the shelter component. Those two numbers are going to tell you about the structural inflation that the Fed is currently fighting. The headline deflation from gasoline that has already reversed and is going to be just a 1 month artifact. Core and shelter are the durable signals that will determine how Kevin Warsh will speak to Congress and how the rate markets will price the FOMC meeting that's going to come up by the end of this month. The bank earnings on the same morning are equally important for your equity and index trading as well. So right now we're seeing that much of the market is forecasting 23.3% year-over-year earnings growth for the S&P 500 in quarter two. The things to focus on inside these bank reports is going to be your net interest margins. And if you are already on TrendSpider Sidekick, you have that right here already. But the major earnings for this upcoming week, it's going to be your net interest margins, which tell you whether the banking system's profitability is holding up under the stable rate environment. The loan loss provisions, which will tell you whether banks expect the credit environment to deteriorate, and commentary from JPMorgan and Bank of America specifically on consumer credit card delinquencies, which is your real-time read on whether the U.S. consumer is still holding up under that 4% inflation. A clean beat on all of those metrics with strong earnings, stable NIMs, and no provision increase, healthy M&A commentary from Goldman and Morgan Stanley. All of that is going to be a significant equity tailwind that's going to push the financial sector up about 3 to 5% and provide broad market support for the week. A miss on any of those, particularly on provisions or commercial real estate, will hit and can hit the sector hard and cascade into a broader risk-off sentiment. And then we have Kevin Warsh, who will be testifying at 10 a.m. Eastern Time or 7 a.m. PST. He has been quite explicit about reducing forward guidance. He's not going to give you a countdown to a rate hike, but the specific thing to listen for and the thing that matters most for every currency and rate trade this week is how he describes the renewed Iran conflict in the context of inflation. Does he treat this energy shock as a supply-side disruption that the Fed looks through, which was Jerome Powell's approach with the pandemic supply chains and which contributed to the Fed being behind the curve? Or does he treat it as a genuine inflation risk that requires a policy response regardless of its origin? So that framing will change the September hike calculus materially, and it will show up in yields, the dollar, and gold within minutes of him speaking. So expect a lot more volatility there. And then very specifically, if you guys are trading NASDAQ, options, or semiconductor related names, Thursday is going to be the most important day of the week, even though Tuesday will get all the attention. And that's because Taiwan Semiconductor will report on Thursday. So let's pull this up here. So Thursday is going to be very important here, Wednesday and Thursday, because TSM is going to report after market close. And so this is going to be the single most important earnings print for determining whether the AI infrastructure spending story remains durable or whether the chip correction that has been running since NASDAQ's peak in early June basically has legs. So here's the context. The Philadelphia Semiconductor Index has had its best quarter ever in Q2. It was up 88% in 3 months, but it has since sold off nearly 14% from its peak. Morgan Stanley's Michael Wilson said directly on Bloomberg Television recently that he expects semiconductor stocks to continue correcting while hyperscalers will stabilize. The AI trade is now starting to rotate. It's getting out of chip pure plays and into the Microsofts, the Amazons, the Metas that have actual recurring cash flows alongside their AI investments. So the question that TSMC will be answering on Thursday is the underlying AI chip demand still real and still growing, or is this correction a sign that the AI capex cycle is hitting a wall? If TSMC's forward guidance shows advanced packaging capacity sold out, stronger pricing power, and robust orders from hyperscalers, the semiconductor correction will get treated as more like a healthy reset within a durable cycle, and the names that have pulled back becoming buying opportunities. If it shows any hesitation on demand visibility or pricing, the chip correction extends and the broader NASDAQ will face a bit more pressure. Then we also have ASML that is also going to report on Wednesday. And as a maker of the equipment that makes the chips, their forward order book is an early read on what TSMC and the rest of the industry will expect demand to look like in about 6 to 12 months out. So that's going to be another thing to watch out for when the market opens up on Wednesday, as ASML will report again on Tuesday, but after the market close. So 2 consecutive strong prints from ASML and TSMC would be the most powerful validation of the AI infrastructure thesis that's available at the moment. All right, so this is one last thing that I want to bring up because this is a story that's buried beneath Iran headlines that institutional desks are running internal assessments on at the moment. More than a dozen Wall Street bankers and private equity executives confirmed to Bloomberg this week that they're working on contingency plans, not for a direct confrontation, but for a world where they're forced to choose between doing business in Riyadh versus Abu Dhabi. Saudi Arabia and the UAE together control more than $3 trillion in sovereign wealth. That is capital that funds Goldman Sachs deals, BlackRock partnerships, and AI infrastructure. And the UAE have backed different sides in Yemen, Sudan, and elsewhere. The UAE quit OPEC in April without warning, and that blindsided Riyadh. Bank transfers from Saudi Arabia to the UAE are experiencing unusual delays. Some Saudi investors are being told that they can only invest in Saudi-focused vehicles. No UAE exposure is going to be allowed. The oil market implication is the most direct. The UAE's exit from OPEC has freed it from production quotas, which means that now it can pump as much as it wants. Saudi Arabia, running widening fiscal deficits and needing oil above $80 to balance its budget, is under pressure from a Gulf neighbor that has every financial incentive to maximize output and compete on price. And the Saudi-UAE price war on top of the Hormuz disruption will create a genuinely unusual setup for oil, which is near-term war premium pushing prices even higher, while medium-term OPEC fragmentation risk will pull in the opposite direction. So this is not just this week catalyst. It is more like, I would say, this quarter structural shift that's worth really understanding here. So on oil, we have the $80 Brent level. That is going to be the line in the sand this week. Anything below it, the market is pricing geopolitical risk without really a confirmed blockade. But anything above that $80 mark there, that market is going to be pricing a supply disruption event. So continue to watch communication specifically for any language about any naval enforcement operations instead of just general strike reports. So we have a major support level down into that $68 level. And on the daily time frame, we're currently holding on to a resistance at 75. A push above that, it's going to take you right into that $80 mark. So that's your cleanest trade. But as you drop down to lower time frames, currently we're sitting into that resistance area. So if you want, you can hold on to a zone here as well. If you're looking for sells to come back down, that is if we get any sort of news around a relief, no more strikes, some sort of optimism in the market, which we know and we're aware of that oscillation pattern. Then we have that drop that's coming right back down to fill in this entire gap closer to the $70 mark. Then we hop over to gold. Same thing on the daily time frame. We have that $4,000 level mark, which is the structural floor. Tuesday CPI core reading is going to be the trigger here. The soft core plus falling shelter inflation will give gold a genuine rally opportunity back to that 4150, even 4200 area. Hot core or sticky shelter will keep the rate hike pressure dominant, and gold will face further downside here to come right back down into 4,000, and then after that it's going to be the next support area coming down into 3925 area here. When you drop down to the 4-hour time frame, same thing. We have a nice little 4-hour consolidation support area that price is currently holding on to, and that's going to be the move to the downside as we catch it, or price holds onto a support and we look for a push right back up. But the main day here is going to be Tuesday for CPI. Then on the dollar, let's start off with Euro USD. The bullish bias through the week will be given due to the dual support of oil-driven inflation and the renewed rate hike repricing. So specific pairs like Euro USD, we will continue to see that weakness towards that $1.13 to around $1.14 area, that border. When you drop down to the daily time frame, you see how the $1.14 was also a very strong support on the weekly time frame and on the daily time frame for all this consolidation to the left, and then also all of this consolidation all of last week as well. Then we're looking at this range here is your path of least resistance that we're looking at, but you still have very clean moves to the downside as you're trying to catch it down into 113. Then we have our GBP USD, which has its own separate UK political tailwind from Burnham's confirmation as PM, but the dollar structural strength caps the upside here for this pair too. So if you come back onto the weekly time frame, tapping into the weekly resistance right here that you can see as price continues to push back, but it was also a very strong support and resistance here to the left too. So this is your 1.34 area. And then also, before you map out this level, look at what is the level that price has to break right now, which is going to be this support to the downside as well, which is your $1.33.2 area. So those are our key levels for this week that we're going to continue to watch out for, and then you're going to have a lot more volatile moves in between to catch as well. Then we have our USD JPY, which remains your highest risk pair at the moment. The 40-year low is still the operative setup here within that 163 to, I would say, around 165 zone. Where am I getting that from? You come back up to the weekly time frame and you see the wick rejections that we've gotten here the last couple of weeks. So 162, I would say. 162.8, bringing you back up closer to the 164 area, and then 165 is a target that a lot of these institutional banks have already very clearly set. Bank of America, JPMorgan, all of them have already identified 165 zone as the next institutional target if the dollar strength continues here. So 162.8 is the first resistance that we have to break past. And if we're going to wait for a continued push down, which is very unlikely in the current environment, given the US dollar strength and the yen weakness, but we still have a floor of 161.3. So before looking for any sort of sells, even if the finance ministers or the finance authorities from Japan interfere, they still have to break below 161.3 first before continuing. So those are some of the key major pairs that we're looking at, especially when it comes to Forex. We can still look at GBP, JPY here, come back onto the weekly time frame, the massive wick rejection from last week here, which is going to be your 218 level, and then also this massive multi-week resistance that price broke above last week and then continue to push back up bullish, which is your 215.75. Drop down to the daily time frame. You got a massive rejection right there from 218, price trying to pull back down, but a bit of a gap up from the news from over the weekend. So here as well, before price continues pushing back down, you need it to break below this daily support and then continue back into 215.75 here. So you still have a pretty good opportunity to the downside that you can catch Give me 1 second here. Okay, I was going to bring up the tool, but never mind. At the moment, it's not working. All right, on equities, we have our S&P 500 first. Let's take a look at that. The S&P 500 right now is sitting just below the all-time high resistance areas. Let's come back up to the weekly too. So just below that, and it has rejected that level multiple times in early June as well. So the setup heading into a week this dense with catalyst is quite classic, that the institutions are simultaneously hedging near term through put purchases while maintaining a long exposure through calls and put selling at lower strikes. We also got that analysis off of Sidekick here and TrendSpider. Once again, I made a video about this, my last video, but they get their data directly from NASDAQ, NYSE, OPRA. So you're getting real data from the actual data providers, liquidity providers, and it's nothing like ChatGPT or Claude, which pulls information from the internet and then you have to filter through it. This is real data from institutions, from the hedge funds, tracking congressional trades that are going on, any insider trades. You're getting real pure data here, so perfectly telling you what the market is doing at the moment. So on equities with S&P 500, like I said, it's a classic with institutions that are simultaneously hedging near term through put purchases while maintaining long exposure through calls and put selling at lower strikes. The options market is also not screaming any sort of crash. It's pricing for volatility here instead. Here are your key levels and liquidity zones as well. But some of the key things here is, again, the options market not screaming for a crash, just pricing for volatility, which is quite different. The directional resolution will happen Tuesday morning, and it is going to happen fast. With NASDAQ, very specifically with QQQ, it's in a defined range between that 710 and 730. So that TSMC on Thursday is going to be the binary event that will determine whether the AI trade will find a floor to extend lower or not. So we have that. We also have some key things that the retail side is missing at the moment. The institutions hedging into earnings, they're not selling. We're getting large S&P 500 and QQQ put flow, which is the insurance on long books. It's not directional shorts that are going on at the moment. Whereas a retail side will see that put buying will mean that's bearish, right? Institutions see it more like portfolio protection while staying net long. They're also selling S&P 500 and QQQ puts at lower strikes that we just saw. And so diversification rotation, it's already happening. I made a video about that, how I'm already pre-positioned as of Friday before the market closed and how to do my full analysis. So that's up there on the YouTube page as well, so you guys can go watch that. So coming over to NASDAQ, since that majority of us trade. And you have our still weekly resistance up top here at 30,300. Then we have our weekly support that last week just bounced off of as well with a massive wick rejection, which is 800. Last week we closed with this minor resistance here, but a massive liquidity wick candle, as you can see to the downside right here, and then push back up bullish. So today, what I'm also going to do is map out that resistance right here in the middle. As long as price maintains above this area, we are all good to go, and we can look for our buys to the upside. And then I also have my minor support down here. So if price breaks below this, then I'm going to switch back and start looking for my sell opportunities. Anything in between is just going to be quick scalps are going to happen. This is the daily time frame, so we have some swing trade opportunities to take advantage of, but anything below this is just going to be quick scalps as price continues to drop back down. So even on the hourly, we had a massive gap down when the market opened up and then filled in that gap immediately with that long wick pushing right back down. So the first target is to see what happens at 29,300 if we end up seeing a support formation and then push back up. So the very important thing here for all equities is going to be continuing to watch what happens on the 4-hour time frame and the daily levels, because you will see a lot of consolidation here. With US 30, let's come back up to the weekly. We have tapped into new all-time high last week and then came back, closed bearish. That is your 29,300, almost 53,000 area, so to speak. And then we also have last week's bottom wick rejection down here at 52. I'm just going to say 52,000, which is going to bring me down a little bit more, which is perfectly fine because if I come onto the daily time frame, that is my consolidation resistance here. So these are the ranges for me for this week. If I drop down to the 4-hour time frame, I see that gap down. The gap has not been filled, but it seems like price is coming back closer to a major support area here too. So same thing as NASDAQ. I want to see if price will hold on to this area as support going into tomorrow's New York session. Or if it breaks through it, then I'm coming right back down into 52,000. Once that breaks, then I'm coming back down into around 51,600 area, all the way down here for another 400 points. But if price holds on to this area as support, then I have a really good opportunity for about 700 points to upside this entire range that I can look for. So these are the major pairs that I'm watching this week that we will be continue to watch in Sherma FX mentorship program as well. On Wednesday, we will have our live session on YouTube. That is going to be at, let's just pull this up, at 7 a.m. PST. So I'll see you guys for that back onto this channel. But very quick for risk management, Tuesday is going to be the most important single day for risk management in months. You have CPI, you have 5 major bank earnings, you have Warsh's testimony arriving simultaneously before the New York cash session even really opens up completely. And so I want to be direct about this. Please do not carry oversized positions overnight Monday into Tuesday. The compression of market moving events into a single morning will create the kind of opening range that can be violent in either direction. And the first 30 to 60 minutes of Tuesday's session are going to be quite just observational. So let the data land, let the bank reactions develop, let Warsh's opening statement hit before you make any sort of directional commitment. For people who are trading on funded accounts, I am building that funded account accelerator. You guys are watching me share more behind the scenes on my Instagram as well. So please, you can follow along there as well. But your maximum drawdown rules are going to be your most important protection this week. Tuesday's intraday volatility alone will produce moves that will test your drawdown limits on normal size positions. So scale down before Tuesday if you can trade micro contracts, and then scale back up, once the picture clears up a little bit. And for all traders, regardless of whether you're trading stocks, forex, commodities, whatever, the opportunities this week are going to be very real. They are going to be very significant, but they show up after the dust settles, not in the first candle after the CPI print. And the traders who do well this week are the ones who let clarity develop before committing capital. So stay disciplined. I will be back with, more analysis throughout the week as well. But like I said, on Wednesday, we will have our live session at 7 a.m. PST. So please follow this channel so you can catch the update the moment that the CPI number drops on Tuesday and on Wednesday as we do our live session.